Precious metals have moved up in price over the years for many reasons, most of them not good. It has functioned for years as a medium of exchange and a store of value. And that's important to know. Most mediums of exchange that we use are abstractions, floating abstractions. Our mutual friend, Doug Casey, once said that the dollar is an IOU nothing, and the euro is a who owes you nothing. They're, in fact, promises printed on a piece of paper. Gold isn't a promise to pay. It's payment in and of itself. It has value separate and apart from a medium of exchange, which is important to know. You mentioned trust. If you acquire gold that you are relatively certain is what it purports to be, you don't need to trust the counterparty. It isn't a promise to pay, it's payment. And when you
Rick, can we explain what a counterparty is real quick?
A counterparty is the person who sold you the gold or who you sell it to. It's the other part in a transaction. Right. When you go to the grocery to buy bananas, the grocer is the counterparty.
Right, or if you lend money to your friend.
Yep. And
they'll pay you back. That's the counterparty.
Yeah, the important thing about gold and silver is that they aren't checks or they aren't fiat currency. They're payment in and of themselves. Right. And in periods of time when there are various forms of turmoil, war would be an example, and social trust is very low, precious metals do very well. Right. Now, my own experience has been that the global perception of geopolitical risk, which is to say war, isn't a long-term impactor on precious metals prices, unless the war impacts you. If you were a Vietnamese person, wanted to leave Vietnam, got off on a boat, gold was worth a lot more to you than Vietnamese currency. But
I saw that too. They were buying the gold leaf and they were trading dollars for gold leaf. I said, why are they doing that? Because they're smarter than you. That's why.
Oh, that's right. That's right. What does move precious metals prices in my lifetime has been investors and savers' fears of the depreciation of their savings and investment instruments denominated in fiat currencies, but particularly, even on a global basis, denominated in US dollars during periods of time when there have either been negative real interest rates or the threat of negative real interest rates, either as a consequence of low rates or high inflation, or both. Gold has done very well. And when you ask about why, right now, I would suggest that there are 5 reasons why people need to be afraid of the maintenance of their purchasing power in conventional instruments, and why I think that gold and silver, are much more likely to do well than poorly. If I may, I'll list them. People often say to me, Rick, when will you sell your gold? Well, when the reasons to own it go away, the gold will go away. So I'm going to give you 5 reasons why I think it'll go up, why I think gold will increase in price. And when those reasons are satisfied, then I'll sell my gold. It's a real simple answer. So let's do them. Quantitative easing, which is a real fancy word for counterfeiting. If you issued Kiyosaki's and went around and tried to spend them in Arizona or wherever you are, that would be a felony. And they would plant you in a slammer. But if you were Congressman Kiyosaki,
there you go.
Then this would be a highly popular policy, something for nothing, and you would be reelected forever.
Congressman sounds good.
Listen, I'd be for it. I think you'd be a ball there. At any rate, it has been estimated that 30% of all the US dollars in circulation have come into circulation in the last 30 months. Now, clearly, this isn't to accommodate economic growth. The economy isn't 30% bigger than it was 30 months ago. There wasn't need for liquidity to manage a buoyant economy. And when you increase the supply of something without increasing its utility, of course, you depreciate the value of the existing stock. There's just no arithmetic way around this. So quantitative easing is the first reason, I think, why investors are concerned about the efficacy of their savings and conventional instruments. But it gets worse, of course. The next is debt and deficits. And this is arithmetic again, too. We have the dubious honor of having crossed $30 trillion in on-balance sheet liabilities. Admittedly, only $22 trillion net of counterfeiting. In other words, the Federal Reserve's balance sheet is $8 trillion. That was printed up. But let's use the 30 trillion. It's their number. But more importantly, Robert, and you and I are partly to blame, the net present value of off-balance sheet liabilities, entitlements, Medicare, Medicaid, Social Security, all that stuff. Not some cranky-old libertarian, but rather the Congressional Budget Office suggests that the net present value off-balance sheet liabilities of the U.S. government, not state and local governments, just the federal government, is $120 trillion. That's 12 zeros, okay, after the 120. I mean, it's a big, big, big number. And we propose to service that debt with a budget that's in a deficit $3 trillion a year. I was taught as a young man, when you're in a hole, stop digging. But that is not what's happening. Many, many, many observers, Buffett included, has said, we're not going to pay this off. We're going to reschedule it. Any creditor, and I'm a creditor, who looks at a borrower, the U.S. government, that has debts that they can't service and they're continuing to refinance them, becomes concerned about their principal. An investor's principal is the savings, the maintenance of the savings in U.S. dollar denominated securities. But it gets worse. The worst is negative real interest rates. For the first time, Robert, in your life and mine, the government has made a promise to you that they're going to keep, and I'll explain that promise. If you lend the government money in the U.S. 10-year Treasury, the base security in the world, the most important security in the world, they promise to pay you 2%, and they will, because they can print it. They don't have to earn it, they can print it. They promise to pay you 2% in a currency that, depending on which government agency you read, is losing its purchasing power at 6.5% a year or 7.5% a year. So they solemnly swear to reduce your purchasing power by 4% compounded a year for 10 years. And they will keep that promise. If you give them money now, they will give you back less later. They're guaranteeing this, and they will do it. Our mutual friend Jim Grant calls this return-free risk. And the whole concept of return-free risk, the whole promise that the government make you less rich if you give them money, is the real reason why people might own gold. There are two more reasons that are arithmetic too, and hopefully amuse you just as well. The first is that the market share of precious metals is the lowest that it has been in my lifetime. Let's face it, we've lived through 40 years of pretty easy economic times. You, as an apartment building owner, every 5 years get to refinance at a lower interest rate. The capitalized value of your rents relative to your cost of capital is certainly low. Sadly, that's over. We've learned in the last 40 years that we don't have catastrophes, so we don't need to own gold. The consequence of that is that the market share of precious metals and precious metal securities relative to other savings and investment assets in the United States is less than 0.5%. Less than 0.5% of the value of savings and investment assets in the United States is in precious metals or precious metals securities.